Thanks, David, and everyone. Thanks so much for joining me today. It's actually this morning. I'm based in the Pacific Northwest, outside of Redmond, Washington. So good morning and good afternoon to all of you. I was super excited when David mentioned that he and Anka were putting together a day focused, or 2 days focused on, basically how investors think and how they make decisions, thinking about psychology and time management, because these are the areas where I've spent most of my career trying to help, mostly institutional investors for much of my career try to address those challenges. And, if I was listening to the previous presentation from Michael, and I was struck by, as he's talking through these things, I've worked with a lot of different investors, from individual investors managing a retirement account to financial advisors managing their, clients' accounts, to money managers managing, 50, $100 billion mutual funds. And I will tell you, if you think that you are unique, or that you are special or unusual, or on your own because you're going through some of these mental challenges, I will tell you that seasoned investors that have been doing this for decades with great success still find ways to struggle with the same challenges that you do. Now, the difference is they often are able to surround themselves with resources and support system and people and things to help minimize those weaknesses or minimize those behavioral challenges and focus on what they're good at. What I want to do with my presentation today, which I've called Better Routines Mean Better Results, is try to give you some of the tools that I've learned have worked for successful money managers and traders that I've worked with over my career. And for me, it's all about routines. The best, most successful investors that I've worked with, and I've worked with some of the top money managers and traders around the world, I have found that what strikes me about what sets them apart from how you may be setting up your time and your days, or they have a really structured approach to how they go about stuff. They are not just haphazardly going in and out and sort of, randomly looking for opportunities and pulling the trigger when it feels right. They have really disciplined, structured approaches. Previously, when I worked at Fidelity, I used to go there, and I'd often try to get there a little earlier. I'd get there around 7 o'clock, and one of the money managers and his analyst would be coming down to get breakfast just before I got there every single morning at 6:45, because their routine was from 6 a.m. to 6:45. That's when they updated a bunch of things. They did it the exact same way. They had the same breakfast and all of that. And while I don't know if you need to be that rigorous, it certainly made me think a lot about what routines I could help you sort of internalize. And I hope you're able to get some ideas, mainly from how I share my own routine. I'll share with you what I call my morning coffee routine. This is the set of things that I look at every morning as a way to try to make sense of the world around me. So as we're talking about this, the general structure to my presentation is I'm going to give you just a little bit of my background and particularly my investment philosophy and why I think the emotional factor, the fear that not dominates the market these days, is the singular most important thing you need to understand. And it's not just about you managing your own anxiety, your own, having a more mindful way of managing your own process, but it's also taking advantage of the fact that there are a lot of other people investing mindlessly and not really developing good routines and being fairly haphazard and being very subject to their emotional drivers. And I think there's an opportunity there for all of us that do have a more mindful approach to understand investor psychology, quantify it, and hopefully take advantage of it. So very quickly, just talking about my background and sort of where I came from. I mentioned some of my work with different investors, and here's sort of my career history in visual format, right? We're talking about data visualization today. I'm assuming you'll see many, many charts, and that's really my background and my passion. So I will share with you my resume in chart format. So I started in the industry in mid-2000 in New York. I grew up in the Midwest. I studied actually music and psychology. So the psychological parts that we're talking about today and that I heard in the previous conversation, I look forward to hearing in the rest of the day, certainly strikes a chord for me because I, as an undergraduate, was learning about how people think. And then when I realized going to New York and working for Bloomberg that there was a set of tools that helped you quantify how investors were thinking, like, I was sold. That's all I needed to hear. And I've never looked back. I've focused on technical analysis and behavioral finance from that moment. Music is another one. Maybe that's a subject for another interview or another podcast. But I will tell you that I have met many successful investors and traders who are musicians. So there's certainly something there. I would argue there's a mathematical relationship that we probably don't think about as much. So if you think about my formative years as an investor, I've often asked people when they started investing, because I find that in a lot of ways, primes them to a certain way of thinking through their career. And if you think about when I started to learn technical analysis, it was during this cyclical bear market in a secular bear market. This was after the tech bubble was just popping. I was learning about investing as I saw, technology stocks and pets.com and all of these go from sure things that were going to double no problem to things that were just a complete disaster. And 9/11 and other things were along the way, which was obviously very challenging. But I really was taught technical analysis and learned it as a way to manage risk. It was all about getting out of charts that weren't working anymore. And the people that I saw that managed that period effectively were the ones that recognized that things were changing, recognized changes in trends, recognized the inflection points, recognized the momentum shifts, the leadership rotation. And so in subsequent periods of my career, when it's been more of a rotational environment, the end of a bull market, I feel relatively well equipped for that. And I'll share with you where that burnt me in my career history. You may be able to guess as you look through the chart. In 2008, I actually moved up to the Boston area and was a managing director of research at Fidelity Investments for about 8.5 years. So I ran 2 of the research departments there, including technical research. So we would provide technically oriented buy, sell, and hold recommendations for all of our equity portfolio managers, and basically provided a technical overlay to their money management process. I was the president of the CMT Association from 2010 to 2014, and I actually just rejoined that organization about 6 months ago, helping to supervise the CMT exam, which is a professional exam for technical analysis. So if you've ever really wanted to learn the details of technical analysis in a structured way, I would certainly encourage you to look at the CMT program. It's pretty well done. Then I left Fidelity in 2016. I actually launched my own firm called Sierra Alpha Research. And if any of you have been in the military or have tried to fly airplanes, you'll know Sierra Alpha is represent the letters S and A, and that stands for Situational Awareness. A lot of what I talk about with my clients and with my viewers at Stock Charts TV and so forth are related to my own experiences learning to fly an airplane and talking about charts with my flight instructor as we were flying around the Boston area. And so much of my own firm has an aviation theme to it. The logo even has a little Cessna silhouette in there. Then about 1.5 years ago, I relocated to the Seattle area. We're near Redmond, Washington, and joined StockCharts.com. I've been contributing content along with some really incredible analysts and experts like Martin Pring and John Murphy and Arthur Hill and many others, and joined as their chief market strategist and moved up here to help build, really build stock charts and empower our users, empower our subscribers to make better decisions using the charts. And we do that with a lot of different ways, primarily with Stock Charts TV, where we discuss market action and focus on a technical overlay to the market activity every day. By the way, if you were wondering what that time was when I totally got burnt, it was right here. I'll never forget it. In 2013, the head of our trading desk at Fidelity called me Dr. Doom because I kept talking about how the market was toppy. And I felt like a rock star genius picking up on this obvious triple top pattern of 2000, 2007, and 2013. I turned very bearish. And this was one of my best lessons in my career, among many, that reminded me to not stay bearish in the face of a rising market. I often quote things like, never confuse the top of the page with resistance. That's one of my favorite quotes as a reminder to stay long and strong when the market keeps going higher. This is where a renewed devotion to trend following and focusing on relative strength was really important to me, because I think the signs, if you look at it now, the signs were relatively clear that the trend overall was still very positive. The market trend model, which I'll share with you in a little bit, that was part of the time when I really focused my effort on developing that a little further than I had up until that moment. So there we go. Any good investor hopefully has great stories of painful miscalculation along the way. I was on a panel a couple years ago in Kuala Lumpur with John Bollinger, and we were talking about, the panel was actually called Man versus Machine. And we had this panel discussion about whether humans or computers were better suited for investing. And it was a really cool discussion. I learned a lot just about, just trying to think about the topic and how I would portray it. But one of the things that I said that I jotted down was, the market's not a mathematical problem to be solved. It's a biological and psychological problem to be better understood. And what what I would argue is that when I've worked with quantitative analysts who come from a physics, mathematics, engineering background, they are incredibly good at crunching data. They are incredibly good at developing models. They will even develop trading systems and models that test beautifully and will show you backtest results that are impeccably good. However, I have seen that happen so many times where then you put live money behind that beautifully backtested model and it just fails miserably. And it usually comes up, related to something about how you actually structured it. And anytime you model, you're making assumptions about what's going to happen. Maybe you didn't model reality correctly. Maybe the world just changed, which it often does. And you have some, tail event that changes the structure of things very quickly, and your model no longer describes the market very well. I think when you model things so much that you get away from what actually drives asset prices, which I would argue is human emotion, when you get too far away from that as a building block, as a basic concept of how you're thinking about investing, I think you're getting too far away from reality. There are plenty of quantitative ways to describe data that, while they might feel like they give you a more rigorous, more disciplined, more structured way of thinking about investing, I still would argue investing is very flawed because humans are very flawed. It is a difficult, subjective, challenging experience. So to be honest with you, the result of that panel, in my opinion, was it's not human or machine, it's human plus machine. I think we're best served when we do things that humans are good at, when you do things that you're actually well suited for, and you use computers, you leverage computing power to address the other things. So for me, I would encourage you, if one of your conclusions from this day is, I just don't need to think, I just need to create some model or follow some model, and that's all I need to do, I think you're missing a really cool part of investing, which is applying your own decision making. And I think what you need to do is focus on what you can control. You can make better decisions. You just need to come up with better routines to allow you to do that. So again, my main word to describe the investing environment, not just today, but any day, is fear. I was taught early on that markets were driven by fear and greed. Fear on the downside and greed on the upside. I would argue that at this point, I would say it's all fear. On the downside, it's fear of losing everything. It's fear of your investments going to zero. It's fear of you were the last person to buy something on the way up and things are going down very quickly. On the way up, it's FOMO. It's the fear of missing out. We're driven, I think, on average by anxiety, and the influx of new investors that we've seen in recent years, sort of the Robin Hood cohort, which some of you may describe yourselves at, people that are newer in the last year or two, going into things like cryptocurrencies and options for the first time, and that's your introduction to investing. The challenge, the challenges as a new investor when you're just getting used to it is usually you're very open and very what's the word? You are very vulnerable, is the word, to behavioral biases, to emotional drivers. And to be honest with you, after doing this 21 years, I'm still very victim to it as well. I've just tried to develop a bunch of routines to help minimize those as inputs in my decision. But when something that you just bought, when you buy Dogecoin and all of a sudden it goes down from 35 cents to 25 cents and you've lost a bunch of your investment, your palms are going to sweat just like mine would, and you're going to start getting nervous. And the likelihood of you making a decision because of that physical, psychological reaction is very, very high. So learning ways to manage your own fear, your own anxiety, and again, quantify the fear that is inherent in the market, I would argue is the best thing you can do right now. Now, how do we actually do that? Well, we're going to talk about the routines that you can use. And for me, routines are all about looking at charts. Technical analysis was a toolkit that was designed, to be honest with you, centuries, if not millennia ago. There's evidence of, many moons ago, and even in ancient civilizations, people speculating on prices of assets. And I would argue that charts are really the latest iteration of speculation. It's human speculation and thinking, anticipating where things might be going. It's very natural for us to try to do that. Charles Dow, whose picture you're looking at, just over 100 years ago, wrote a series of essays for Barron's where he described what we now think of as Dow theory. He talked about looking at indexes and quantifying trends and thinking about how to measure the strength of the economy and when economic conditions were starting to be more challenged. A lot of what we've done since then as a technical analysis community is put more detail, put more rigorous, quantifications, putting more models, more computerization behind a lot of the basic concepts that Charles Dow talked about, and really trend following. If you ever look at a chart and say that's going up or that's going down, you were using Charles Dow's input in some small way in your investing. For me, the best way that you can understand what's happening in the market is by looking at a bunch of charts and quantify and basically decide what's working and what isn't. The way you do that is by following trends. When I first learned about trend following as an investor, I had first worked with a lot of traders, a lot of short-term investors, swing traders. So there were, at hedge funds working at, sometimes sub-second timeframes, trying to make really, really quick movements, but also, swing trading a couple of days at the most. And it was all about mean reversion at that time frame, right? It was all about buying weakness and selling strength and sort of trading around a certain price center. What I evolved with over my time, working more with long-term investors at Fidelity and working with a lot of financial advisors with my own firm, I focus a lot more on long-term investing and following trends. There's a thing called the momentum factor, which you may have read about or heard about, which is a very widely researched and validated approach, which says if you're investing out about 3 to 6 to 12 months or so, the best thing you can do is not buy weakness and sell strength, but buy strength and sell weakness. You're better off buying things that are working, because on that time frame, trends tend to persist, right? You're better off owning things that are working. And if you look at what's working right now, it's things like banks, it's home builders, it's industrials, it's materials like Freeport-McMoRan, energy stocks, arguably. What's not working? Peloton, right? Breaking down through a huge head and shoulder top, arguably earlier today. It's a lot of the growthy things that had really good runs through last year have been consolidating and now starting to roll over, especially on a relative basis. The idea of trend following is to lean into what's working, to lean away from what's not working, and having a regular process of repeating that. And the way that I do that is using some quantitative models that I'll share with you, but it's also having a disciplined process every day, every week of reviewing a bunch of charts and making sure that I understand what's happening out there in the world. So I would argue in what we focus on in my work at Stock Charts for individual investors and for advisors is that, you basically have 3 things you should be trying to do with your investment portfolio, with your clients' portfolios. Number 1, identify trends. And that's really what we're talking about here, focusing on the fact when we're looking last December at this chart, that semiconductors were in a strong uptrend, making new highs, making new relative highs. Those are the types of charts. If I had a portfolio of charts that looked kind of like this, I probably would not feel too bad about my overall prospects for further upside. These are the types of charts that tend to work if they've worked like this for a little while, especially on this last 6 month sort of time frame. So number 1 is identify trends. Number 2 is follow those trends. Put yourself in a position to capitalize on what's working, to lean into. I always say lean into what's working and lean away from what's not working. And this line at the bottom is the ratio of the semiconductor ETF, the SMH, versus the SPY. This is looking at semiconductors versus the broad market. And overall, when this line is going higher, that tells you this group is outperforming the S&P. When the line would be going down, which it's really not on this chart, then the group is underperforming. If you update this chart to today, by the way, the relative strength line has rolled over in a pretty big way, and the price is coming down as semiconductor stocks have been struggling a bit here in recent days and weeks. So certainly an inflection point or a rotation of sorts in recent history. So the first thing is identify trends. The second thing is to follow those trends. And then the third thing, and this gets to my next slide, is to anticipate when those trends are exhausted. I worked with Tom DeMark off and on earlier in my career when I was with Bloomberg, and he taught me that an uptrend is ending, or uptrend ends not because of an influx of sellers, it's because of an exhaustion of buyers. You want to find ways to identify when a trend is no longer going up. That gives you an early warning signal, a red flag that things might start to be getting worse. This was the early warning signal that I got from semiconductors, and this is the previous chart was sort of up through that moment, continued higher for about 3 more months, and then we had this sort of pattern, which is called a bearish divergence, a bearish momentum divergence. From January to February of 2021, you see the SMH making new highs. You can see that the relative strength, the RSI, is making lower highs. That sort of bearish divergence of higher highs in price, lower peaks in RSI were some of the things that suggested to me that the growth trade that had been so strong up until that moment is most likely going to be alleviated. And from here, as you probably know, we've had more of a consolidative, choppy period. The chart of the AARKK, the ARK Innovation Fund, comes to mind as something that's pulled back significantly from that peak and now sort of in a coil pattern, a sideways pattern, potentially breaking down this week through the lower end of that pattern. By the way, the 200-day moving average is what I'm looking at there. for sure. But you've certainly seen a rotation away from that growth trade into sort of more the value trade, things like industrials and financials and materials. So that sort of divergence is what suggests to me that we may be ending what's going on. By the way, we're going to look at a chart that looks a lot like this one. It's called the S&P 500. We're going to look at it in a little bit. When I start my morning coffee routine, I'll actually show you what the chart looks like, how that relates to this chart of semiconductors a couple months ago. Now, I mentioned my own firm is called Sierra Alpha Research, and basically the reason why I called it that was because of the aviation concept of situational awareness. You were taught, if any of you have learned to fly an airplane, I still have a great deal to learn, but I've flown about 80 hours in a Cessna 172R for the most part. And this is what the panel looks like. So you have the dashboard, sort of the view outside above here, and then here is all the information telling you about what's going on within the airplane. And you're taught to basically have a regular process of looking at all these instruments and making an assessment of what's going on with the airplane. What are the conditions? How are things working? Any issues? Where are you at? And all of those sorts of things. And I'll give you an example of why situational awareness is so important. My first night flight was basically, you have to have a couple hours flying at night to try to understand the dynamics there. It's very different than flying during the day because it's dark. Obviously, you have a lot of lights on the ground. On a clear night, you have stars in the sky, lights on the ground, and it's harder to see the horizon. It's harder to see things like mountains and things that don't give off natural light. And so, depending on where you're flying, it could be kind of a challenging period. So you really have to learn the process of it. And the first time I had a night flight, I'm flying with my instructor in the right seat. And he said, all right, I'm looking down at my map, trying to just make sense of where I'm at. And he said, all right, do you see something important around 10 or 11 o'clock? And I kind of looked, straight off to the left. I'm like, I don't think so. Nope, we're good. And I kind of looked back down. He's like, are you sure around 10, 10:15, there's not something really important? And so now obviously there's something I'm missing. So I look off to the left and I sort of look in the distance and I see like headlights. I see a floodlight coming at us. I'm like, oh, yeah, it looks another plane, our altitude. He goes, that's right. So we're pretty close to a collision course. One of us has to move. So we tried to radio the other pilot, couldn't get a hold of them. So we flew down about 500 feet. The other plane never deviated course, kind of kept going where they were going. We flew underneath them and got back to our normal altitude and kept going. Now, the chances of us actually, coming into contact with another plane, it's actually pretty hard because there's a lot of space up in the air, but we would have been way too close for safety purposes. And what it reminded me of is not get just so caught up in what I'm trying to do that I forget to actually just look around me and understand what's happening. And you are taught how to look at this panel and in a couple of seconds be able to understand everything about the operation of the plane. You're taught to look outside with a normal scanning process, starting in the middle, looking to the left, looking all the way to the right, and doing that all the time just to make sure you know what's around you. You do clearing turns, which are these big left and right banks to make sure you know if there are any planes around you and make sure you have visual contact with them. So as investors, it's so funny how we forget to do that. You get very focused on one particular chart. You look at your trading plan or your particular thing. You're looking at the E-minis and you're looking at it in a vacuum and you're just focused on that one particular chart. But what I've learned is that one chart is one of thousands, if not millions of charts that are all changing. They're all fluctuating and they're all related in some large or small way. So, often I have found that, especially for financial advisors, for individual investors, it's not about making good decisions with the stocks or ETFs that you've selected. It's the process of making sure that you're looking at the right charts in the first place, right? So something like real estate comes to mind this year. Real estate's one of the better sectors in the S&P year to date. The price has been in good shape. It's making new highs and the relative strength has been pretty important. But when's the last time you looked at stocks like SPG, Simon Property Group, or one of those REITs that no one ever really cares about? But if you look at charts, if you looked at a momentum model and sort the sectors based on their strength, you would see real estate popping up toward the top. If you screen for stocks making new 3-month highs, which I do once a week, you would notice things like SPG popping up on the list. And so I've often found some of my best investment ideas going back are things that I would not have normally found. I did them because of a process of looking at a bunch of charts and screening for ideas. And I hope what you're able to find through this discussion is just a window into what my own process is, and then help you think about what your process should be to try to identify ideas. Now, it's not just about market awareness and awareness of what's happening around you. It's also what's happening inside your head. And again, I caught the second half of a previous presenter Michael Fulgara. I thought his comments were chilling. I was humbled by what he was saying. I was like, man, I really have to do better here. It's making me feel like I really need to get on the ball with how I'm thinking. But I think his comments were absolutely spot on. It is such a mental game, and a lot of your performance, depending on how you have structured your process, a lot of your performance could absolutely be attributed to your mental state, and not just the decisions you're making, but the process you go through to make those decisions. And I always tell people when they're making a trade, lay out what is the list of things that you do to determine whether or not this is a good trade. And I'll show you in a moment why that is so important. So to be honest with you, what I meant to say there is, I think, you have to have good self-awareness, which means you have to have a good, honest, regular conversation with the voice inside your head. And what I have found working with a lot of investors, and my blog on StockCharts.com, by the way, is called The Mindful Investor. It really applies a lot of mindfulness techniques to investing and just how you go about making better decisions. And I will tell you, it's about having an honest conversation with yourself, because that voice in your head a lot of times is the most negative voice you're ever going to hear. You will say things to yourself that other people would never dream of saying to you, because it's pretty rude and it hurts. But that's what the voice in your head can often do. Having a regular dialogue through journaling and meditation, I can't tell you enough how much that can be a game changer for you. So how do we make better decisions? I would tell you it comes down to routines. And again, the name of my presentation is Better Routines Mean Better Results. I firmly believe that you're going to do better as a trader, better as an investor, if you have better routines. I've often talked about there are things within your control and things outside of your control. And it goes back to the serenity prayer, right? Grant me the serenity to, and I'm going to completely screw this prayer up, having not looked it up ahead of time, but basically to plan for what I can, to not worry about things I can't control, and the wisdom to know the difference. That's a horrible paraphrase, but you know what I'm getting at. Work on what's in your control and not what's out of your control. And I have found that we often worry about things that are out of our control: the market environment, what this chart is going to do, what our coworkers might do, what our clients might ask us about, instead of worrying about what we can fix, which is how we make decisions, what we look at every day, what we put in our minds that is financial related. Are we looking at financial media, and when and how? These are all things you have direct control on. So make changes, make upgrades to what you actually can control. And it's so funny, we tend to fly off, we tend to create our own sort of one-off process when we're trying to make decisions as investors. And what I learned learning to fly planes is everything is laid out in a very structured way. When your engine cuts out in midair, while it can be challenging, it's not something that causes anxiety after you've been doing it for a while, because you've done so many simulated engine failures that it's just a checklist that you follow like any other checklist, and you do what you do. And that's what allowed Sully to land an airplane in the Hudson River. It was not a panicked, oh my gosh, what am I going to do? It was like, all right, can I get there? Can I get there? Nope, I need to land in the river. Here's how I do it. And he just followed the normal process that a good pilot should have done. He was, making good decisions, practicing good decision making at a time where if you weren't trained effectively, you probably would have panicked and made very poor decisions. So this is actually the segment of the pre-flight checklist just before you start the propeller on a Cessna 172R. First off, you turn the master switch on, you turn the beacon on. It's an emergency beacon, so if something would happen, people would be able to find you. You open the throttle a little bit, the mixture idle, cut off the fuel pump, the mixtures, the fuel mixture, fuel air mixture, the fuel pump you don't need on the ground. And there's all these set of things that you're doing right before you yell out the window and turn the key and launch the propeller. And 99% of the time when I did it, it came on just fine, because I'd already done 100 things on a checklist that confirmed everything was working appropriately. The chances of a mechanical issue in the plane are minimal. So what you are trained to do is everything has a checklist: getting in the plane, getting out of the plane, turning the propeller on, turning it off, an engine failure, a stall, everything has a list, and you're just trained to go to the list and follow the steps. And that's how you get through things in an emotionless state, or minimize the impact of emotions. That's how you don't panic. So my question to you is, have you made an investment decision in recent days, in recent weeks, in recent months where you did not follow a checklist very well? And I bet if you think hard, you can come up with at least one, and hopefully not many, where that is how you would describe it. And my argument is you better have a good checklist that you follow. This, by the way, is my general technical checklist for any sort of trade. It starts with Dow theory. Is this chart in an uptrend or a downtrend? Trend lines. Are there any key trend lines I can draw on the chart that tell me about the characteristic of the trend up until this moment? Where are we at relative to the key moving averages? Where are they? Are they sloping upwards or downwards? Are we testing them at all? Patterns, any price patterns like the head and shoulders in Peloton that might help me understand the dynamics of what's going on. Any key support and resistance levels I should know, right? Any levels previously which have been important for this stock or this ETF. Confirmation, can I look at things like MACD or PPO or average true range or some indicator that helps me understand price movement a little more and qualify what I've seen in the first 5 steps. And then the very end, if I'm looking at an equity or an ETF, it's all about relative strength. How does this particular asset relate to my average, my passive asset, the S&P 500 usually, and is this outperforming or underperforming? And if I've followed those 7 steps, if I've answered those 7 questions, then I have earned the right to decide whether or not I want to buy or sell that security at that given moment. When I have taught technical analysis at the college level, by the way, we spend the semester building this checklist, and by the end, I have them stand in front of the room and analyze charts and answer those questions. And I always tell them, you cannot say bullish or bearish. You have not earned the right to say buy or sell until you have gone through and answered those 7 questions. Then you can do it. I make them write it out by hand as I was taught to do. So I would encourage you, this does not have to be your checklist. Your checklist may look very different because you're looking at different asset classes or your time frame is different, and that's totally fine. I've always told people an imperfect, consistent routine is way better than a perfect, inconsistent routine. I would worry less about the specifics on your checklist. That'll get better over time. I would concern yourself with having a checklist and following it consistently. That's how you would determine what should be on your checklist and what should not be on your checklist, and it'll get better and more meaningful for you over time. So, what is your process for market awareness? How do you actually consume financial data? When do you turn on something like CNBC or Bloomberg TV or, God willing, Stock Charts TV and understand what's happening around you as an investor? What do you read? What newspapers or blogs or articles do you read every day? When do you look at your own portfolio? I would say the answer to all those questions is going to impact how you interpret the world around you. And I'll give you one of the obvious ones. I'm often asked about financial media because I'm, technically, I guess, part of it doing a daily closing bell show, but I also go on financial media. I'm quoted in the media a lot. And so I've thought a lot and talked a lot about how I think investors should be using financial media. And I will tell you, I don't think it's a bad thing. I don't think financial media in general gets a bad rap because they tend to sensationalize things. They tend to build any little thing into a big thing. And that comes from the fact that you're trying to draw attention and something that's crazy, that's outlandish, and some ridiculous target like Bitcoin to 5 million is what draws a lot of attention. So that's why you have to do that. However, I think there's value. I think there's value in hearing from experts and understanding how people have been doing this longer or in a different way than you have, what they're telling, what they are seeing in their own process. I don't think that's a bad thing. What I do think is a problem is where it fits into your process. If the beginning of your process is firing up CNBC and seeing what's happening, I would argue you are missing the boat, probably 99% sure that that's the case. That is arguably the worst time to look at financial media. I think it should be later in your process. Once you have analyzed your own data, once you have made your own decisions, once you have consumed the right information about the market, gathered evidence, and decided, here's what I think as an investor, here's how I'm positioned, then I think you should be looking at financial media to see what someone else is doing with a different toolkit, then relate it back to your own. If you just listen to what someone else is saying and then swap out your own process for theirs, which is what you're basically doing if you hear someone mention a ticker or an investment thesis and just follow it, I think you're missing out on your own. You're minimizing your own ability to consume and digest information and make good decisions. I would focus more on your ability to do that, and I think you absolutely have the ability to do so. So having said that, here's what I would like to do. This is literally a snapshot of my morning coffee routine. I call it the morning coffee routine. I'm actually going to go to live charts now. I call it my morning coffee routine because literally this is what I do every morning. I get the cup of coffee, usually, after getting ready for the day, usually give my 5-year-old son breakfast. I come upstairs to the home office these days. At some point, I'll be going probably to a physical office again, but for a while now, it's been the home office. and I fire up this list of charts, and with my cup of coffee, I start taking notes on what's happening right now. And I look at the same set of charts every morning. I have a separate routine every week that goes Thursday, Friday, Saturday, Sunday, Monday that helps me think about more long-term trends in the market. But this is how I make sense of what's happening at any given moment. This is why if you ask me later in the day, what do I think about X? I've looked at it at least one time. Now, again, keep in mind, I'm a technical analyst. My job is to look at a lot of charts. So your morning coffee routine certainly does not need to be this comprehensive or this chart oriented. There may be other things that you want to look at. Again, my argument is you need to have a routine. So for me, it always starts with a weekly chart of the S&P 500. And even if you're a day trader, even if you're a swing trader, I would argue the best thing that you can do is start with a long-term chart of the S&P 500, if that's the area of the market that you're looking at. If you're trading equities or ETFs or futures or something like that related to equities, because you need to understand the long-term trends. There are trillions of dollars being managed on this time frame, and understanding that as a headwind or tailwind to your shorter time frame is super, super important. I think a lot of short-term traders get affected by long-term investing, and they don't realize it because you see orders come in and you don't understand that it's part of a much larger cycle that you're not operating on. You better understand that there's a lot of money being managed on a long-term scale. This is the weekly chart that I look at. It uses what I call the SAR, the Sierra Alpha Research Market Trend Model. It has three components using weekly exponential moving averages. This is the long-term model, which is basically looking at a very long-term trend based on the 21 and 34 week exponential moving averages. This model turned bullish in early June of 2020 after we were established well above the March lows, and it has remained bullish since then, which makes absolute sense. That's the long-term trend. I could buy that. The medium trend for me is just a weekly MACD or the weekly PPO using the traditional settings that Jerry Apple created. And it's literally sort of my main investing model. When this is on a buy signal, I feel good about taking on more risk, looking for long ideas, looking for opportunities to the upside. When this is negative, this is when I think more about defense. It's when I think more about risk management and less looking for, more about raising cash and less about looking for the next home run. And you can see it's been negative a couple times here in October, sort of the middle of this digestion period. I don't have a problem with that. Here in February, which was after that a bullish divergence, which we'll look at here in a minute, turned back bullish as the market made new highs, remains bullish through today so far as we're recording this. For me, the short-term model, I really look at the daily chart more often for that, but I have this as a quick proxy for just a short-term trend, and it's looking at where we are at every Friday close relative to the 5-week exponential moving average. I don't update this model until Friday after the close. And so, at this point, it is bullish across the board, short-term, medium-term, long-term. So even though I see some areas of concern, and we'll talk about that in a moment, I still think the long-term trend and the short-term trend remain overwhelmingly positive. By the way, these Chrome tabs that you see at the top is literally just the tabs that I showed on the screen a moment ago, and I've just laid them all out so I can look at each chart at a time. My next chart that I look at is a daily chart of the S&P 500, just to look at the last year and understand what's happening. And again, keep in mind as I'm showing these charts, my time frame on average is about the next 3 to 6 months. That's when I generally try to think of things. So I'm looking down the road at least 1 month. I'm not looking at shorter term timeframes. So those of you that are, that's fine. These may not be the exact charts you would look at. But again, I hope this shows you how, for my time frame, these are the things that make sense to me. If you are more of a long-term investor, I'd encourage you to look at something kind of like what I'm showing you, because I think it makes a lot of sense. If you're more of a short-term investor, you just need to adapt these for the timeframes that you're interested in. I would be looking at more hourly charts, for example, and 5-minute charts to understand the shorter-term dynamics, but make sure that it's a routine that fits you and your process and your time frame. The daily chart for the S&P, by the way, looks like this to me. I would argue that we are in an exhaustion phase. I would say we're in the later stages of a bull market trend. I think we've had an incredible run on stocks, and I think certain stocks and groups will continue to do well. But I think we're absolutely overdue for at least a 5 to 10% correction. And here's why. Chart here at the top, you see what's called a bearish momentum divergence, higher highs in price, lower peaks in RSI. This should look familiar if you remember the chart of semiconductors that we looked at a little bit ago, which was showing a very similar pattern a little bit before the eventual peak in semiconductor stocks. You can see on this chart, I've highlighted the last time you had this particular divergence where we were overbought on the first time and then did not reach the overbought region on the second one. That was in January of 2021. Now, if you look at the chart there in January, you'll see we made higher highs in the second half of the month. We made a lower peak in momentum, so higher highs in price, lower peaks in momentum is called a bearish momentum divergence. You can see soon after we broke a trend line, taking the low from October, the low in January, and the low from mid-January. So all of that suggested further weakness. There we went down around 4.5% to 5%, just a little under 5%, if I remember right. Bounced off the 50-day, made another new high in February. We had another 5+% correction, made it below the 50-day for one day's close, and then came right back and went back above it. So I would argue, I think we're in a situation where we get at least to the 50-day moving average, which is right around 4,000. This makes sense to me for a couple of reasons. Number one, the 50-day moving average is right above that level. Number two, if you take a trend line from the October low to the March low, it lines up almost exactly to that same 4,000 level. So if we break 4120, which is the low from mid-April, and boy, it felt at one point yesterday morning, felt like we might just do it in one day there. But overall, we're bouncing nicely so far today's trading. But overall, I think we break 4120. I think we get down to that 4,000 level. We break 4,000, and you would hear me start talking about much deeper downside, like 3,700, which is around the 200-day moving average, 3,200, which would be the low of the September, October 2020 low period. I think once we break 4,000, you have to start thinking about some further downside potential. But at this point, first things first, I think I've seen the exhaustion signal. Even though the trend remains positive, we keep making higher lows. When we stop making higher lows, which would be a break below 4120, I would be concerned on the tactical time frame. The third thing I look at are a series of what I call the U.S. equity market indexes. And if you glance through the tickers here, it's things like the Russell 2000, the large, mid, and small cap, micro cap indexes, looking at Dow theory, looking at the value line indexes. And again, I often look at a candle glance page, which is a feature on stock charts where you can look at a bunch of different charts at once. And it's funny, when I was at Fidelity, we did a lot of things. We printed out so many charts there. It was a lot of printing and drawing lines on paper charts, but we would often take a bunch of charts and throw them on the big conference room table and sort them out into piles, what looked good, what didn't look good, and we'd make notes on them. And that was a great way to sort of separate things. This is the electronic version of what we used to do years ago, which is basically take a bunch of charts, put them as little thumbnails, and look to see what's working and what isn't. And when you look across this pile of charts, I'm struck by this: the S&P in a clear uptrend, the NASDAQ composite, however, not confirming the most recent high, right? Not really getting to new highs, not moving significantly above that 14,000 level from February. The Russell 1000 making new highs, but the Russell 2000 not. So you have large caps going higher, large and mid caps, but small caps not confirming that. The FANG index not making new highs. Small caps, I mentioned already, not making new highs. Micro caps, if you want to think about the challenge with the current market and the lack of participation from some of the more risky, higher beta groups, I would look at the IWC, which is the microcap ETF. This is looking as sort of a consolidation period, sort of a topping pattern. A break below this neckline would be a bit of a concern. We haven't done that yet. So at this point, small and micro caps are not breaking down. They're just not going up anymore. But again, that's how things tend to start. That's how a bear market tends to start. And that's why I'm looking at those charts. So overall, this is a great way to just make sense of what the different pieces of the US market look like. I would also point out the strength in transports. It's an incredible chart going from lower left to the upper right. Up and to the right is good, is what we would always generally say. Next, I will look at global markets, non-US markets, and I do that through the major regions, IFA, EM, and frontier markets. And then I will look down at a number of country ETFs, common ETFs, and things that have jumped out at me in my recent daily reviews of this are the weakness in Asia, right? If you look at the average chart, pretty good. Look at Canada, decent chart. Look at Italy. Not bad, right? Pulling back a little bit. Look at France making new highs, Spain making new highs again today overall. Compare that to what you see in Japan, more distributive. Look what you're seeing in the FXI or the MCHI. Those are China ETFs. The FXI, by the way, just this week went below its 200-day moving average for the first time since September, which is a bit of a head fake. And before that, you're going back here to the cyclical downtrend in the first quarter of 2020. So the fact that China in February making new all-time highs and all of a sudden back and retracing 38.2% of the way, testing the 200-day moving average, potentially breaking down through that this week. I think that's certainly an area of concern, and a break a little bit lower sort of indicates increased potential of going further down from there. So seeing the outliers in Asia versus other developed and emerging markets was an important take there. Also, the strength in frontier markets, look how it's continued to make new highs as well. I then look at a group of charts called intermarket analysis, and this is where I'll look at commodities and in general, the strength of commodities. Some of the more interesting charts I'm seeing right now are things like crude oil, things like the DBC or the GCC. These are broad commodity ETFs. Look at the overall trend in the chart of crude oil, making a new high here in March. This is the continuous contract I'm looking at, by the way, pulling back to an ascending 50-day moving average. The RSI doesn't get below 40, which is kind of classic bull market behavior, right? You become overbought when the market makes new highs. When you pull back, you remain above 40. That's sort of what a bull market phase sort of looks like. Compare that to a bear market phase like you saw in the first half of 2020, where you become oversold on the downturns. You don't get above RSI 60 on the kickbacks to the upside. So overall, very constructive, a nice rotation higher, making new swing highs and new swing lows. I would argue, I think we're in the middle of a very strong cycle for commodities. I would argue that some of the commodities lag behind. Things like gold and silver are really starting to improve. I put a video on my YouTube channel talking about this oversold condition, this bullish momentum pattern with higher lows in the RSI as the gold, the GLD and the gold contract, the gold future had hit low. So basically the GLD hit its low from June of 2020, came right back to that same level. It also happened to be a 61.8% retracement of the March 2020 low and the August 2020 high. From there, we retraced. Look how we bounced beautifully off some of these Fibonacci levels, and then we hit 61.8%, and now we're rotating back higher. I think there's further upside for commodities in general, but also precious metals. This is where I'll look at things like the dollar, things like cryptocurrencies, and understanding things and just how they relate to one another. And again, some of these may be a little too much in the weeds depending on what you're looking at, but you can see if my goal is to understand all of these different pieces of the market, I better be able to look at all of these charts regularly. And the idea is I look at them in the same way every single morning. So this process I'm showing you is literally what I do first thing in the morning. So I just have a piece of paper where I'm jotting down a bunch of notes on everything that I'm telling you right here. Other things that have stood out to me on a recent view, the dollar that had been weak in the month of April, sort of hooking higher a little bit, and a stronger dollar would be a little different than what we've seen than what we saw in the month of April. And then thinking about what that might mean for different assets. I mentioned the role higher in crude oil. Aussie dollar, Japanese yen, AUD to JPY is sort of a classic risk on versus risk off sort of metric. This has been risk on for 6 months leading up to around late February of 2021. For there, it's been sort of in neutral mode, which is about how the equity markets have felt, right? You're making new highs. It doesn't really feel good because some of the growthy stuff has not really participated. So overall, that's one of the charts I would look for to see if we move back to more of a risk on environment, or if this starts to break down, that tells me that that we may be entering more of a defensive posturing. Final thing I would say is a long-term investor strength in copper is pretty strong. That tells you about economic demand. Strength in lumber. This is why the chart of home builders makes sense, and Home Depot and others. Those are all stocks and groups that are working very well, and strong lumber prices are pretty significant. Anecdotally, I feel like everyone has maybe a good lumber story, depending on where you live. Here in the Pacific Northwest, I live out in the woods. We have about 5 acres in the hills leading up to the Cascade Mountains. We had the power company come in and cut some trees down to make sure they wouldn't affect because all of our lines were just hanging out through all these evergreen trees. They're trimming the trees back a little bit. They cut down a couple pretty big evergreens, which was unfortunate, but it had to be done. And I've had people literally pull in my driveway and leave a note asking if they can get the wood, because the wood is so expensive. You can't get your hands on firewood because there's such a run on it. Luckily, we live in the middle of huge forests here, and there's plenty of it. But I'm getting real-time offers for wood out in my front yard, so that tells you something about the price of lumber. Then I go through, now I basically at this point covered all the major price trends. I have a sense of what's happening with stocks, commodities, currencies, interest rates, and how they relate to one another. Now I start to get more into the ways to understand the equity markets in a little more detail. And that for me is 3 parts: breadth, sentiment, and ratios. And I'll just show you an example or two in each one of those. For breadth, I look at things like this as the cumulative advanced decline lines for the New York Stock Exchange, common stock only, the S&P 500, so large caps. This is the mid cap index. This is the small cap index. And I'm basically looking at the daily advanced decline lines, turning those into cumulative measures to understand the overall trend in stocks going up or down over the course of over periods of days and weeks and months. And what I'm noticing recently is most of these have continued to go to new highs in the month of April. The NYSE, that's a check. The large cap index, check. The mid cap index, check. The only one that has not confirmed the recent new highs at the end of April was the small cap index. The small cap breadth not confirming new highs, but overall, not too bad. Another one perhaps that I would look at is this one. This is the percent of S&P 500 members above their 200-day moving average. Here in blue, at the bottom in green, the percent of stocks above their 50-day moving average. This actually had been up around 93, 92% a couple of weeks ago. Now is down to around 80%, and that's not much. That's about 12% of the S&P breaking down through its 50-day moving average, but that means 10% of the S&P is broken down through its 50-day moving average. The beginning could be the beginning of something something more deep. And I'm seeing as of yesterday, you saw that break down a little bit more. We make a little lower high. We continue to go down. That's telling you that stocks are not holding their 50-day moving averages. They pull back a little bit. And that would be a potential area for concern. Overall, the long-term trend is positive, but I'm starting to see some weakness where stocks are actually breaking down. Then I would probably run some screens to identify which stocks are actually making those moves. When I think about sentiment, a couple ways that I measure it, but this is the chart I would show you. Shows you two themes: the name exposure index, which is here in black. In red, these bars are the RIDEX flows. And very simply, how I would describe it, the name exposure index tells you money managers basically say every time they're surveyed what's your exposure to equities. Long, 100% long, 200% long, 100% short, 200% short, or flat, 0% equity. And they're able to update that regularly. And the most recent weekly reading was just over 100%, meaning the money managers as a cohort that were surveyed were leveraged long. That tends to be more of a late stage bull market pattern, not always, right? So you saw that they were leveraged long here in August of 2020. The market continued higher for a month before sort of pulled back into September, but it tells me we're maybe nearing the end of that period. The RIDEX flows, by the way, are the lowest that they've been in the history of the data series. And I've plotted this inversely so that it's more similar to what you see with the name exposure index. But basically, this being so low means that individual investors in the RIDEX funds are most bullishly positioned than they've ever been. They're in things like bullish ETFs and sector ETFs as opposed to cash money market sort of ETFs or things like that. And so overall, basically, the anecdotal investor is all in, right? They've made their buys, and that again, what fits into the narrative of the exhaustion pattern. Now, I have a series of ratios that I follow, and again, I don't have time to go through all of them in detail, unfortunately, but I'll show you one or two of them. One is looking at the equal weighted consumer discretionary versus consumer staples. That's a series here at the bottom in blue. The cap weighted version, looking at the XLY versus the XLP, it's not bad, but the problem is stocks like Amazon, Tesla, Home Depot are so big, they're an outsized weight in that ETF. So if you buy the XLY, you're basically buying a basket of Amazon, Tesla, and Home Depot, and then you've got a bunch of other little things that don't have as much of an impact. So the equal weighted versions of those sectors show you what is the basket of consumer discretionary stocks doing versus the basket of consumer staple stocks. And this is a ratio that I've looked at for years. One of my mentors at Fidelity named Bill Doan, who ran the group in the 1970s, looked at a previous version of this, not using ETFs, of course, but using stock data to look at within the consumer space where investors leaning more on offense or defense. And this is, I find, a good way of adapting what he looked at and looking at it. And overall, it's basically saying within the consumer space, investors are basically still bullishly positioned. Here's the relative performance of semiconductors. This is one of the ratios that I looked at. The fact that it appears to be rolling over and certainly looks toppy to me, testing its 200-day moving average for the first time in about 11 months, testing this swing low from March, I think is an area of concern. Semiconductors tend to be a bellwether group, tends to do well in a bull market phase, tends to underperform in a bear market phase. So that breaking down is not a good sign for me. The way I wrap up my daily or my morning coffee routine is looking at sector rotation, which is looking at the 11 S&P sectors, how they rotate around the benchmark, and then looking at the 11 S&P ETFs. And things that jump out at me here are materials, industrials, Real estate, even though real estate pulling back this week overall has had an incredible run. Energy hooking back higher, financials to the uptrend. I did not mention things like technology and communication service because I would argue the charts are not as attractive at this moment. Finally, I would look at factors, looking at momentum and value and other things like that. And then after all of that, I have then earned the right to look at my own portfolio or my client's portfolio. And there's a reason why this tab is not over here on the far left side before I look at anything else. If the first thing you do is bring up your holdings or your portfolio, or your client's portfolio, I think you're doing it wrong. I think you need to put it over here on the far right side. Look at that after you've looked at everything else. Once you've looked at all this data and you decide, here's how I think I should be positioned, look at how you're actually positioned. Look at what stocks you own. I'm just using the Dow as a proxy for sort of a stock portfolio. Then you would make some decisions as to why am I owning Procter & Gamble and Merck and Walmart right now, or Salesforce, if their charts are not justifying me owning them right now. Let me look through and see, am I positioned for higher rates or stronger stocks or defensive movements or whatever that I've learned from all that other data that I've paid attention to. So that is my morning coffee routine. That is the way that I make sense of the world. That's the way that I start big picture and go more and more specific. That's the way that I thoughtfully include things like financial media and incorporate my own holdings, but do it after I've built a good market awareness or situational awareness. By the way, I've prepared a handout. If you go to my website called marketmisbehavior.com/routines, you can actually download a PDF with my own checklist that I just showed you in checklist format. You're welcome to use that as a starting point. And then also I gave you a blank page you can fill in your own checklist. I would encourage you, print that out, write out the steps that you follow in your checklist and start to follow it every day. Hang it on your monitor, hang it on your wall and see how well you can actually stick to it. I host the Closing Bell Show on Stock Charts TV. If you go to StockCharts.com, you'll see that it runs every weekday, 6 p.m. Eastern. So if you follow my work or what I do, that's the way that I sort of debrief every day on what I'm seeing with the charts. And then finally, if you can read the tickers on the last slide, you get my final message, which is thank you. I really appreciate it, David and Anka, including me today. I enjoyed very much hearing the presentations I've seen so far. I'll look forward to hearing what some of the other presenters say. And if you have questions on what I got to today, my email has been up on the screen the whole time. You're welcome to shoot me an email. I'm happy to answer any additional questions because we don't have a lot of time for it today. But thank you all very, very much.